Good afternoon, ladies and gentlemen. My name is Kishore Mahbubani. I'm the Dean of the Lee Kuan Yew School of Public Policy, and it gives me great pleasure to welcome you to this event to discuss the lessons from the EU crisis. And of course, this is part of the S.T. Lee Distinguished Lectures, and we're very happy to host it here at our school. Now, I normally make 3 points, so I'll make 3 very quick points about today's session. The first one is that, I think we are all aware that we do live in remarkable times. You sort of assume as you get older, you get to know the world better and you can sort of predict what's coming. I find that as I get older, I get more and more surprised. I never thought I would live to see the day when Donald Trump might become president. But when I was in Davos in January, a very well-known Harvard professor, David Gergen, shocked all of us when he said, "Don't rule out the possibility that Donald Trump might become the next president." And of course, the other pillar of stability that I always thought we could count on was Europe. We thought Europe would be dull, boring, predictable. Instead, Europe has given us a lot of excitement. And so it's actually that if you want to look for a sort of very timely topic to discuss, I can't think of a more timely topic than this one. So my second point is that it's important to emphasize that Klaus Regling can speak with great authority because he actually was the head of the European Financial Stability Facility, EFSF, that was created as a temporary crisis resolution mechanism by the Euro member states in June 2010. And of course, the EFSF and its successor, ESM, has provided financial assistance to Ireland, Portugal, Greece, Cyprus, Spain. So the man handling this obviously had to be at the center of the crisis, and therefore I think Klaus Regling was, in a sense, there's no better person to talk about a crisis from the internal point of view. But before that, I would suggest that let us at least give Klaus a special round of applause for saving the euro. So. And I also want to finally, my third point, briefly introduce Klaus to those of you who do not know him. He has worked for 35 years as an economist in senior positions in the public and private sectors in Europe, Asia, and the US, including a decade with the IMF in Washington and Jakarta, and a decade with the German Ministry of Finance, where he prepared for the Economic and Monetary Union of Europe. And from 2000 to 2008, he was Director General for Economic and Financial Affairs of the European Commission. Before all that, he had also gained experience in the private sector as a Managing Director of the More Capital Strategic Group in London from 1999 to 2001, and he also was an economist with the German Bankers Association. He studied economics at the universities of Hamburg and Regensburg. But the most important thing you need to know about Klaus Regling is that he's a member of the Lee Kuan Yew School family. He spent 1 year at the Lee Kuan Yew School of Public Policy in Singapore in 2008, 2009, and as he was telling me earlier when we were chatting, that being in Singapore at the height of the crisis as it emerged gave him a completely different perspective of what was happening, and therefore when he went on to become the head of EFSF, the perspective that he gained from Singapore and our school was very useful for him. And as a result of that, I can tell you that we've had many people in our school who have come and spent some time with us. No one has been more loyal than Klaus. He keeps coming back regularly to speak at our school. So another round of applause for Klaus Regling for being such a good friend. Over to you, Klaus.
Thank you very much, Kishore, for your kind words. Indeed, it's a great pleasure to come back here from time to time. It feels like homecoming. Also good to see some familiar faces in the audience and some good old friends. And indeed, this 1 year at the Lee Kuan Yew School during the crisis was particularly important for me. It was good to see how Asia was handling the crisis. And I was sitting in this little office on the second or third floor, 12 hours, of course, ahead of United States. So when the Federal Reserve put out statements, typically Sunday at midnight, Washington time, it was 12 noon on Monday, and I could see in real time how they closed down Lehman Brothers and all these other problem-solving measures, AIG. And I had a bit more time to think about it. So that was indeed very, very, very useful and also a very pleasant year. So I will talk about Europe today. And as Kishore said, it's never boring. And the last few years actually a bit more exciting than we all wished, but certainly interesting. Certain problems are under control now, new problems are appearing on the horizon. Also that makes life interesting. So what I plan to do, first look a little bit at the growth situation and explaining that we are back to normal, what are the bright spots, what are the weaknesses. There are some new risks coming up. Then I will, as a main part of the presentation, talk about the response to the euro crisis, the response that we developed during the last 5-6 years, and then finally what's now on the agenda going ahead. So on this slide you see the growth, how it developed over time, and you see that Europe was actually hit by 2 crises over the last few years, and that's made it so difficult because combined these 2 crises led to a situation that created the worst economic situation in 80 years in Europe. The first crisis was the global financial crisis that hit everybody around the world. Of course, Asian countries a bit less, but basically it was a global phenomenon, triggered in the United States by subprime mortgages and a financial system that was not well supervised. So this happened in 2008 and 2009. But then 2 years later, we were hit by our own crisis, homegrown crisis, the euro crisis. We can't blame anybody else for that one. The problem was that it hit so quickly after the first one. But by now we are moving out of that. Growth in the euro area is somewhere around 1.5, 1.7%. Pretty stable. When the IMF revised its global outlook 2 or 3 weeks ago, the euro area was the only region in the world where forecasts were moved up slightly. Most other parts of the world there was a downward revision, not very much, but it was down. For Europe it was up. So that confirms that things in Europe are, in that sense, quite stable at the moment. Also, when I saw this morning in the newspapers reports that exports from Singapore to the rest of the world have been dropping dramatically, actually. It was pointed out that only exports to Malaysia and to Europe have been growing. So I think we can also take that as a confirmation that indeed in Europe the situation is quite good and domestic demand is strong. There's another reason or another way to look at this when we look at GDP growth per capita, which then takes into account that demographic trends in Europe are not very good. low birth rates, stagnation in population, and some countries even a decline in population. Taking that part out, you see that GDP per capita growth in Europe has been the same as in the United States, until the crisis at least. And that's true the 10 years before the crisis, but also 20 or 25 years before the crisis. Many people think that growth in the US is always higher than in Europe, and that's just wrong. It's higher when you look at it overall, headline growth, but taking into account the different population developments, it's actually the same number to the decimal point. And I think we are moving again in that direction. The crisis opened a bigger output gap in Europe than the US, that's true. So we can actually grow a bit faster for a while to close this output gap. But then after a while we will grow again at the same speed, which is not surprising because Europe, US, we are mature economies, and the speed of growth is basically determined by technological progress, which is spread over the advanced economies sooner or later. There's another point that's interesting to make in this context. When one compares Europe with the US, the income distribution in Europe is much more even, much more equitable than in the US. On the left-hand side, you see only the US, how the different income segments developed the last few decades since the late 70s. And you see the top line, the yellow top 1% of income earners, they had an increase during this period of 140%, while all the rest was very moderate. And actually the lower half of the income distribution, they had no real income gain since 1990. So very uneven distribution of income. And this may have a lot to do with what we see in the primaries with Donald Trump and Bernie Sanders. People are just getting very unhappy with the old elites. On the right-hand side, you see also how income developed in relative terms in the US, Germany, France, and Italy. And this measures the top 10% earners in relation to the bottom 10%, the lowest 10% earners. And you see that in the US it's around 5, this relationship. In Europe it's between 2.5 and 3.5. But it also has been going up more in the US the last 10 years than in Europe. So there is a problem in the US, and I think it's another positive for Europe that in the end should provide also more political and social stability. So here again we have seen these two crises. I already talked about that, the global crisis in 2008-9, then in 2010 the sovereign debt crisis. Deficits were too high, public debt too high, countries lost competitiveness. There were housing bubbles in a number of countries. There were also gaps in the institutional setup of the euro area. And there was insufficient supervision of the financial industry, like in many other countries. And then the unthinkable happened. Countries that had joined monetary union lost market access. This was not supposed to happen. Once a country passed all the tests, it's not easy to join the euro area, but once all these tests are passed and the country actually joins, it should not lose market access. This was not foreseen, and therefore we also did not have the appropriate instruments in place to deal with such a situation, and therefore a breakup of the euro area became a real possibility. But in response, a comprehensive strategy was put in place. When you read newspapers, you may get the idea that there was a lot of ad hoc decisions on Sunday nights at 4 o'clock before markets opened. And a lot of that happened, it's true. But still, with hindsight, indeed, it is a comprehensive strategy that addressed all the major problems. And this strategy comprised 5 elements. The first one is that the countries had to do their homework. Those countries that lost market access, that got into trouble, whatever the trouble was, they had to fix it. I will talk about that in a moment. Second, in a crisis, one needs an active monetary policy. The ECB is doing that. Third element, we needed better, closer, stricter economic policy coordination, because the criticism has often been from the beginning that monetary union cannot work. Some Anglo-Saxon professors argue, where only monetary policy is centralized and everything else is done in a decentralized way. So our response is it can work, but it needs to be coordinated well. And we are doing that much better now than before. The fourth point is that we had to strengthen the banking system. And the fifth one is that we had to close those institutional gaps, creating new institutions. These are basically the ones that I manage. So let me go through these 5 points. And I'm sorry, Kishore, it's 5. I couldn't reduce it to 3 because it's so comprehensive. So let me go briefly through these 5 points. So first, countries had to fix the problems, obviously, otherwise there's no lasting, sustainable solution. So they have been doing that. These are the countries in the chart that required emergency financing. I also added Germany as a reference point. And you see that fiscal deficits are becoming smaller. This is often controversial. There's a debate about the speed, but there's no disagreement about the direction. Every country in the euro area will bring the deficit again below 3% of GDP and then to structural balance. And there can be ups and downs from year to year, but the direction is very clear. And overall, you see on the right-hand side of this chart that the euro area has made good progress actually. Last year the aggregate fiscal deficit, the blue line, was 2% of GDP, while it was 2 times or 3 times that much in the UK, the US and Japan. So good progress. Not quite there, all the countries, but the progress is visible. The second point that was important as a reason for the crisis was the loss in competitiveness in a number of countries, and this was indeed quite significant. Here the left-hand side measures or shows how nominal unit labor costs developed in these countries, cumulative since the beginning of monetary union. And when you look at the light blue line, that's the one at the top, that's Greece, you see that their unit labor costs from 2000 to 2010 increased 45% faster than the bottom line, which is Germany. But for Germany, you could say Northern Europe, it would be similar, Netherlands, Austria, Finland. So a divergence of 45 percentage points. This is not sustainable. When wages and costs go up that much faster in a country that cannot move its exchange rate, there will be a problem. And the problem you see on the right-hand side, it shows the current account deficits or trade deficit, and Greece had the biggest one, more than 15% of GDP, but also the other countries, Spain, Ireland, Portugal, large current account deficits, not sustainable. But the good news is that since 2010, the situation has been improving quite radically. So these lines are coming down, as you see very clearly, particularly for Greece, but also for the other countries that are going through adjustment programs. At the same time, Germany, because they are cyclically more advanced, quite naturally has now higher wage settlements than before. So from two sides, this gap, which was far too big, is being closed. So the countries that had lost competitiveness basically have regained competitiveness in a very painful way, because they had real cuts in wages, salaries and pensions. Something that economic textbooks say cannot happen. And maybe that's another reason why many people in the Anglo-Saxon world first didn't understand what was happening here, because this is not supposed to happen. When I studied economics, which is some time ago, but I think textbooks have not changed so much, they say that nominal income cuts don't happen. Well, in the euro area now they do happen, if unavoidable, because it's painful. Nobody likes it when the income is cut by 20 or 30%, but that's what happened in Greece, Ireland, Portugal. And it's a very quick, painful but quick way to restore competitiveness, and the only fast way, because the nominal exchange rate is not available to be moved. So good progress with the regaining of competitiveness. The current account deficits, you see it on the right-hand side, have basically disappeared. But the country's also implemented lots of reforms. That's still part of doing their homework. It's very difficult to measure progress in structural reforms because one has to add apple and pears. How do you combine progress in labor market reform with pension reform, with product market opening? I wouldn't dare to do it, but the OECD does it. And they know a lot about structural reforms. They have an indicator every year that they measure for every OECD country, so not only Europe. And the countries that went through adjustment programs and received emergency financing, they have, according to the OECD, implemented more reforms than any other country in the OECD area. So that's encouraging because we know from economic history very clearly countries that implement reforms will have a better growth performance after a number of years. Not immediately, that's the political dilemma. Sometimes a new government comes in and reaps the benefits, but the better growth will happen. We saw that also in cases that went through very tough IMF programs, like in Brazil or Turkey or Indonesia. Also very controversial at the time, very painful for the population, but a few years later these countries were among the best performers in the world economy, including Indonesia for a long time and Turkey, Brazil for a long time. Now they are falling back again. So this experience is quite well known among economists, and therefore I think it's very easy to predict that these countries in the periphery of Europe that went through these difficult adjustment periods will do better than the rest of Europe in the medium term. They will have a good growth performance. So that was the first element of the crisis response. The second, monetary policy. The ECB has done, like other big central banks around the world, a lot of unorthodox monetary policy measures, providing liquidity, buying government bonds, other securities. They were the first major central bank to introduce negative deposit rates. All this, of course, attempting to get bank lending going again and bringing up inflation. They are not there yet. The ECB would like to see inflation or inflation expectations moving to their target of just below 2%. At the moment, headline inflation is around 0, core inflation around 1%. The difference is the energy price. But a bit worryingly, inflation expectations are only around 1.4, 1.5%, even in a 10-year horizon. So they are struggling with that, like the Bank of Japan is struggling with inflation. Even in Singapore, I see in the numbers that inflation is lower than the central bank would like to be. So it seems all advanced economies have a problem here. But the ECB has certainly done its very important share to help the euro area get out of the crisis. And at certain points in time, the communication from Mario Draghi has been very, very important. The third element of the crisis response is the better economic policy coordination, as I mentioned, very important in a monetary union where fiscal policies and structural reforms are decided at the national level in a decentralized way. We always had fiscal surveillance and fiscal rules to make sure that no country runs excessive deficits. It has not worked fully, but it has had some positive impact. These rules have now been tightened and made stricter. Political interference is more difficult. There's better coordination by providing budget plans earlier. The European Commission can analyze them, partner countries can comment on them, so that when every country, every national parliament that continues to be responsible for the national budget, when they take their final decision, they know all the comments, they know the possible spillover effects, so they take their final decisions better informed. Importantly, there's a new procedure that goes far beyond the fiscal side. It's a procedure to avoid excessive macroeconomic imbalances. This did not exist before the crisis, but we learned during the crisis that other elements, as I mentioned, divergences in competitiveness, credit bubbles, housing bubbles, can lead to serious problems. So this new procedure looks permanently at the development in these macroeconomic aggregates. There can be recommendations to countries, there can even be sanctions if countries don't follow the recommendations. So it's now a much tighter and broader surveillance framework that we have in place. The fourth point is the banking system. Banking system, of course, is important for every economy. Like in many other parts of the world, the global financial crisis hit also the European banks quite significantly. In response, we created new institutions. An important one that's not well known in the broad public is the ESRB, which stands for European Systemic Risk Board. It has the mandate to look at macroprudential risks. This is something that has now become very fashionable. Before the crisis, macroprudential risks were largely ignored. Not only in Europe, also the US and UK have created new bodies with that mandate to look at macroprudential risk. I think also in Singapore this is a strong focus now of the authorities to look at macroprudential risks. The important point is that that's all good, but in a monetary union, such a macroprudential body is even more important, because this is an area where country-specific tools are available. Monetary policy in a monetary union cannot be used in a country-specific way. It's the same interest rate for each country. But for supervisors, there are tools that can be applied only in one country. So if, for instance, Ireland were to go into another housing bubble one day, like they did 10 years ago, they could use macroprudential tools like tightening loan-to-value ratio only in Ireland, not in other countries. So that's good. The tool was already available 10 years ago. The supervisors in Ireland didn't use it, but there was also nobody in Europe to tell them to use it. So that's the advantage of this new body. We have also new supervisory bodies for banks, insurances and securities markets. Importantly, the banking union, what we call banking union, started in November 2014. There's now one European supervisor for the most important European banks. That's 130 banks, systemically important. They account for 80% of all banks' balance sheets. So the other 6,000 banks have the other 20%. So the biggest banks are supervised by the SSM, a European body. We created single resolution mechanism, single resolution fund, also at the European level. We created a new resolution regime. There will be bail-in the future of creditors if public money is needed in order to avoid the use of too much public funds. So it's really a new supervisory and resolution regime. Importantly also to remember that European banks have added 600 billion euro to their capital since 2008, and that means a doubling of their capital. So whatever you hear right now about European banks being at risk or because their stock market has been declining. It's true, there are also problems. There are problems with profitability, but their capital situation is much, much stronger than 6 years ago. So they are much less at risk than they were before the crisis. And that takes me to the fifth and final point of our crisis response. We closed institutional gaps. I already mentioned EFSF, ESM did not exist before the crisis. So, because we never thought that a country could lose market access after entering monetary union. We saw that this happened, first with Greece, then with Ireland, Portugal, Spain and Cyprus. So very quickly in 2010, the EFSF, European Financial Stability Facility, was created. I was asked to build it up from scratch. It was always seen as a temporary institution, and then it was replaced in 2012 by the permanent international institution, the ESM, European Stability Mechanism. So legally the two entities are quite different, but politically it's the same. They have the same mandates, the same instruments. Together they have a lending capacity of 700 billion euro. We lend, like the IMF, only against conditionality. So countries have to commit to changes in their economic policies, review that every 3 months, otherwise there's no disbursement of funds. We have supported 5 countries during the last 5 years with 254.5 billion euro, so that's a lot of money. It's about 3 times as much as the IMF has been lending during that period globally. The 5 countries are Ireland, Portugal, Spain, Cyprus and Greece. 4 of these 5 countries are now success stories. They have exited their programs, or Cyprus is very close to exiting. They can again refinance themselves in the market at reasonable interest rates. They are growing again. Unemployment is coming down, although from high levels. Like in Ireland, unemployment has fallen from 15 to now 10%. Growth is back. Ireland has 6.6% growth last year. Spain had 3% growth. So 4 of the 5 are by now success cases. And Greece is unfortunately a special case. Sometimes I say many families have a black sheep in the family. You don't drop them, you try to help them. Greece is our black sheep. And we help them massively. They got their 3rd program last year, committed up to 86 billion euro, 20 billion has been disbursed so far. Even Greece made good progress until 2014, then it was interrupted by the government the first half of last year, where they stopped reforms, but now they are coming back towards a reform path, and that will over time lead to growth. So when I look at these institutions that we created in the crisis, really new institutions, what are the benefits? Without creating these institutions, some countries would have been forced to leave the euro area, and that would have been really regrettable and would have changed the nature of Europe today. Also, another benefit is that the reforms really work. The programs work, they stimulate reforms, the reforms will lead to more growth. These programs also mean that debt sustainability is supported by us very much. Countries can again regain debt sustainability, and there's one table here that shows the benefit of the lending from EFSF and ESM to the 5 countries that received emergency financing. If you look only at the Greek line, there the numbers are the biggest because they received more money than anybody else. In 2014, the Greek budget saved 7.8 billion euro because of our favorable lending terms. And that's 4.4% of GDP. And this happens every year for 30 years. Because we only charge our funding costs, that's less than 1%. The IMF, for instance, charges 5%. So we are a lot cheaper. That saves them real money. And if they continue to implement reforms and start growing again, it can all add up to to moving back to debt sustainability. So that's another benefit of having these new institutions. They also make risk sharing in the monetary union more important. And in a way, we have created now a lender of last resort for the euro area. There were many people who had not understood that with the creation of monetary union, there was no lender of last resort for the sovereign. Of course, the ECB, central bank, like in any other country, is the lender of last resort for banks. That's normal. But in the monetary union, the ECB cannot be the lender of last resort for the sovereign. This is something the Fed does in the US or the Bank of Japan. In Japan, they buy government bonds. The ECB cannot do that because that's against the Maastricht Treaty, monetary financing. It also would shift risks between countries, and that should only happen with parliamentary approval. So there was a gap here, no lender of last resort for the sovereign, and we closed that. So all in all, I would say with these 5 elements, the countries are doing their homework, the ECB is taking crisis measures quite appropriately, better policy coordination, stronger banking system, and EFSF and ESM. This is really a comprehensive strategy and explains quite well why the euro crisis as such is coming to an end, with Greece remaining a very special problem. It does not mean that we don't have some other problems in Europe. Life is never boring, as Kishore said in the beginning. And let me mention 3 of them here. One is that we have to do better with productivity and potential growth. Because, if I can remind you, I already showed the chart on the left-hand side. GDP per capita growth, we are like the US, so that's probably fine, and we cannot expect much more than that. We're actually doing better in the labor market than the US. Our employment rate has been rising over the last 15 years, while it has been falling quite significantly in the US over the last 15 years. Often people only look at the unemployment rate and say European unemployment is twice what the rate is in the US, and that's true. But that's only one part of the picture. The other part is employment rate, participation rate. So actually more people have a job now in Europe, despite the high unemployment rate, than in the US. So that's positive. But given that the same growth rate, better employment situation, something has to give, and that's productivity. And that you see in this chart. In productivity, Europe has fallen behind over the last decade. So that's what one should focus on, and that indeed what also Europe and the European Commission is focusing on. We economists know what needs to be done to strengthen productivity. One needs structural reforms, one needs more investment. There's a Juncker plan. One has to promote research and education. We have to clean up banks' balance sheets so that they can start lending for the real economy. So for economists, very simple. Political implementation, sometimes not so easy. But I think the agenda is well set here. We know what should be done. Another, and that's a new issue, is immigration. I'm sure you read about it. It's a new phenomenon because the numbers have become so big. Europe has always had immigration. That's nothing new. But all of a sudden, since the middle of last year, the numbers have skyrocketed. More than 1 million in 6 months. And it will continue. It will not stop all of a sudden. And this is a problem because the numbers as such are big already. And also these migrants want to go to basically only 4 countries. They want to go only to Germany, Austria, Netherlands, and Sweden. And that makes it a bit problematic because the EU has 500 million people, 1 million, that's 0.2%. That doesn't sound so much. But because they want to go only to these 4 countries are reaching the limit of what they can accommodate in terms of housing, medical care, schooling for the children, integrating the people in the labor market. So it's a real challenge. It's now the biggest challenge that Europe has, and some countries in particular. It's also a great opportunity, because in the short run it adds to government spending. Germany alone will spend this year, only in 2016, 20 to 25 billion euro. That's about 0.75% of GDP. That will stimulate demand and growth, obviously, and might even reduce the current account surplus. In the long run, it's an opportunity because the demographics are bad in these countries. Without immigration, the population in Germany would shrink very soon, following Japan. So to the extent it's possible to integrate these migrants into the labor force, it's actually very good in the long run. But because there are such big numbers, it's a question mark whether it can happen. So opportunities there, but also the risks are there. And so that's clearly is right now on the agenda, and there's a summit in Brussels today that looks at the British question, but also at the migration issues. Another point important on the agenda, particularly important for me, my institutions and monetary union, is how integration in the monetary union will continue. With all the changes I explained earlier, the 5 elements, monetary union will already now function better than before the crisis. Still, it's good to think about additional steps to make monetary union more robust, and a number of points are on the agenda, are under consideration. There's a proposal from what we call the 5 presidents. That's the president of the European Commission, president of the Council, president of the Eurogroup, president of the ECB, and president of the European Parliament. They have proposed a 3-stage integration process over the next 10 years. And the immediate agenda items are to complete banking union. There's one important element missing, the European Deposit Insurance Scheme. Another proposal is to begin to work on a so-called capital markets union, which would create more financial market integration and more cross-border flows, which would be helpful to smoothen out different cycles in the member states and lead to more risk sharing. But this raises difficult issues because one needs to harmonize taxation systems, insolvency laws, company laws, which are deeply embedded in national legal systems, which in some countries have been growing for centuries. But it's a good objective, but it will take time. Fiscal union, political union are longer-term goals, require changes in the EU treaty. Under discussion, a limited fiscal capacity for the euro area or a separate euro area budget, the euro area finance minister, more democratic legitimacy and accountability. Good to start thinking about it, but it will take many years to get it done. So let me conclude. After the crisis, I think we have learned some lessons. The recovery is quite good. We are a little bit nervous what's happening in the rest of the world, because in the end it will also affect Europe. We are part of the globalized world. But in general, developments compare well with the US, including, importantly, on the income distribution side. We saved the euro. Thanks for your applause earlier for that. It was hard work, but worth it. The crisis has also brought us closer together. This happens in a crisis, particularly in Europe. We show a lot of solidarity with the weaker countries. I showed how much money they save, and they are implementing reforms. Of course, reforms need to continue. We need to work on productivity, potential growth. Migrants, we need to work on integrating them, and further integrating the euro area is also a worthwhile objective. Thank you very much for your attention.